The stock market is a battlefield designed to transfer wealth from the active to the patient. It is an arena where the disciplined prevail over the impulsive. The difference between the professional speculator who builds fortunes and the amateur who consistently loses is not found in secret formulas or superior intelligence. It is found in habit. The market is a mirror that reflects your internal discipline or lack thereof. It rewards sound habits with wealth and punishes poor habits with ruin. There are 8 foundational habits that separate the two, and understanding them is the first step toward moving from one column to the other in the great ledger of the market. First is the habit of meticulous planning versus the impulse of gambling. The amateur comes to the market seeking action, a thrill. He operates on hunches, tips, and the desperate hope for a quick profit. He treats the ticker as he would a roulette wheel, placing his bets and praying for the best. The professional, however, approaches the market as a general preparing for battle. He has a clearly defined strategy for both entry and exit before a single dollar is put at risk. He knows what conditions must be met for him to act, and what will prove him wrong and force a retreat. I learned this lesson at great cost. A man I respected, Percy Thomas, a very intelligent and successful trader, once gave me a tip on Union Pacific. He was so certain, so convincing, that I abandoned my own reading of the tape and followed his lead. The stock went against me, and I lost heavily. It was not the monetary loss that stung, but the violation of my own principles. I had allowed another man's opinion to overrule my own hard-won judgment. From that day, I resolved to play a lone hand. The professional relies on his own study, his own system, and his own discipline. He knows that tips are the siren song that lures the amateur's account onto the rocks. They are given by people who either want to unload their own stock on you or who are simply repeating a rumor they heard themselves. In either case, you are acting on second-hand information, which is always too late. The rule: the professional trades according to a pre-written plan. The amateur trades according to a whim. Before you enter a trade, you must know, with absolute certainty, the exact price at which you will exit if you are wrong. If you cannot define this, you are not speculating, you are gambling. Your plan is your only defense against the market's greatest weapons, hope and fear. Second is the habit of strategic patience versus the disease of constant action. The amateur feels that if he is not in a trade, he is not making money. He is agitated by the thought of cash sitting idle. He jumps from one stock to another, chasing every minor move, paying a constant tribute to his broker in commissions and to the market in small losses. He is always busy, but never profitable. The professional understands that the great bulk of his profits will come from only a handful of trades each year. His most difficult work is not in buying or selling, but in waiting. He waits for the market to align perfectly, for the line of least resistance to become clear and undeniable. He can sit in cash for weeks, even months, observing, studying, and preparing. He knows that cash is a strategic position, preserving his capital and his mental clarity for the one moment when the odds are overwhelmingly in his favor. I have often gone fishing for weeks at a time, not because I was tired of the market, but because the market offered no clear opportunity. It is in these quiet periods that the next great move is born. To act when the market is unclear is to sail into a hurricane. It is better to remain in the harbor, patient and prepared, than to be torn apart by the cross-currents of a confused market. The money is not made in the buying and selling, it is made in the sitting. The rule: the professional is paid to wait. The amateur pays to trade. Cultivate the discipline of inaction. When you are in doubt, do nothing. When the market is a messy, choppy affair, do nothing. The market will always be there tomorrow, but your capital will not be if you squander it on low-probability trades born of impatience. Third is the iron habit of cutting losses without hesitation, contrasted with the ruinous practice of holding on and hoping. The professional views a small loss as a necessary business expense, an insurance premium paid for the privilege of being in the market. When a trade moves against him, he does not question the market. He questions his own timing. He exits immediately, preserves his capital, and waits for the next opportunity. The amateur does the opposite. When a stock drops after he buys it, his ego becomes entangled. He cannot admit he was wrong. Instead of selling, he begins to hope. Hope is the amateur's greatest enemy. He holds on, convincing himself it is a temporary reaction. When it drops further, he may even buy more, averaging down in a desperate attempt to lower his cost basis. This is the single most fatal mistake in speculation. You are reinforcing failure. I learned this in a cotton trade where my initial judgment was correct, but my entry was premature. The market went against me. Instead of taking my small loss, I became angry. I held on, stubborn, and the small loss ballooned into a devastating one. It taught me that the market is never personal. It does not know you exist. To argue with the tape is to argue with the tide. The rule: the professional cuts his losses short. The amateur lets his losses run. You must establish a definitive stop-loss point before you ever enter a trade. My personal rule was never to lose more than 10% on any single speculation. If a stock goes against you by that amount, you must sell. It is not a suggestion. It is an unbreakable law. Your first loss is always your best loss. Fourth is the habit of letting profits run versus the fearful tendency to snatch small gains. The professional understands that the goal of speculation is to capture the large, decisive moves, the big swings. Once he has a profitable position in a stock that is acting correctly in a favorable market, his job is to sit tight. He resists the temptation to sell for a small, quick profit. He knows that winning stocks tend to keep winning, and his patience will be rewarded. The amateur is terrified of seeing a small profit turn into a loss. This fear compels him to sell far too early. He will take a 2-point gain and feel clever, only to watch in agony as the stock moves another 50 points without him. He is consistently cutting his flowers and watering his weeds. I was once told a story about an old trader, Mr. Partridge, whom everyone called Old Turkey. In a roaring bull market, younger traders would watch him hold his positions for months. They would sell and buy back, scalping small profits, and ask him, "Aren't you going to sell and lock that in?" He would peer over his spectacles and say, "Well, you know, it's a bull market." He was not trying to catch the minor reactions. He was focused on the major trend, and he made a fortune by simply being right and sitting tight. The rule: the professional aims for the home run. The amateur bunts for singles. It is never your thinking that makes the big money for you. It is your sitting. Men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn. But it is only after you have mastered this that you can make the big money. Never sell a stock simply because it has gone up. Sell it only when your analysis of the market conditions tells you the move is over. Fifth is the habit of absolute independence of thought versus the need for social validation. The professional speculator is a lone wolf. He does his own research, forms his own conclusions, and acts on his own judgment. He understands that the opinions of the crowd are a contrary indicator. The moment speculation becomes a popular topic at dinner parties is the moment the top is near. To protect his own thinking from this noise, he works in isolation. I eventually took a private office away from the brokerage houses and the constant chatter of other men. It was not an act of arrogance, it was an act of survival. In a room full of traders, you are constantly bombarded by tips, fears, and hopes. This collective emotion is a powerful force that can sway you from your own plan. A speculator must be his own man, or he is no man at all. The amateur, on the other hand, craves consensus. He is uncomfortable making a decision alone. He asks his broker, his friends, his barber for their opinion. He wants someone else to tell him what to do, so if the trade fails, he has someone else to blame. This external validation makes him feel safe, but it guarantees his failure, for he is acting on the emotions of the herd. The rule: the professional trusts the tape. The amateur trusts the crowd. You must learn to think for yourself. When you have done your work and your plan is clear, you must have the courage to act on it, even if no one else agrees. The market pays for correct, independent judgment, not for being part of a popular consensus. Sixth is the habit of analyzing general market conditions first, before ever considering an individual stock. The professional is a student of the entire forest, not just a single tree. He knows that the most important factor in any trade is the direction of the overall market. Is the tide coming in or going out? In a bull market, money flows into stocks, and even mediocre companies can rise. In a bear market, money flows out, and even the strongest companies can fall. Therefore, the professional first determines the line of least resistance for the market as a whole. Only then does he begin to look for the leading stocks in the leading sectors. The amateur does the reverse. He hears a story about a particular company and buys the stock, oblivious to the fact that the entire market is rolling over into a downtrend. He is attempting to swim against a powerful current and wonders why he makes no progress. It is futile to be bullish on a single stock when the entire market is bearish. You may be right about the company, but your timing will be wrong and you will lose money. The rule: the professional trades with the trend of the market. The amateur trades a story against the trend. Before you risk $1, you must diagnose the character of the market. Is it a bull market, a bear market, or a sideways trendless market? Do not place a bet until the tape tells you that the major forces are aligned in your favor. Seventh is the all-important habit of focusing on capital preservation over profit maximization. The professional's primary objective is not to make a fortune, but to survive to trade another day. He treats his capital as his lifeblood. He is, first and foremost, a risk manager. He knows that if he can protect his downside, the upside will take care of itself. This principle of protecting the bankroll is the cornerstone of a long career. I went broke several times, and each time it was because I violated my own rules of money management. I became overconfident, took on too much risk, and allowed my ego to dictate my position size. The lessons I learned from those painful experiences are the most valuable I possess, and they form the core of my life's work, which is detailed in the pages of Reminiscences of a Stock Operator. I urge every serious student of the market to read it, not as a story but as a blueprint for survival, and you can find a link to it in the description of this video. The amateur, in stark contrast, is obsessed with profit. He asks only, "How much can I make?" He risks far too much of his capital on a single trade, dreaming of that one big score that will change his life. In doing so, he ensures that one bad trade will end his career. The rule: the professional plays defense. The amateur plays offense. Your number one job as a speculator is not to make money, but to protect what you have. If you can successfully avoid large losses, you will almost certainly be profitable over the long run, because the winning trades will eventually come. Survival is victory. Finally, the eighth habit is reacting to the market's behavior versus holding a fixed opinion. The professional trader knows that the market is never wrong. Opinions often are. He does not try to predict the future. He is not a fortune teller. He is a tape reader. He watches the price action and volume, what in my day we called the ticker tape and what you would call your live price feed, and he reacts to what it tells him. If he buys a stock and it goes up, the tape confirms his judgment. If he buys it and it goes down, the tape tells him he is wrong, and he gets out. He has no emotional investment in being right. His only investment is in his capital. The amateur, however, forms an opinion and then seeks to impose it on the market. He believes a stock is undervalued and should go up. If it goes down instead, he does not see it as a signal that he is wrong. He sees it as the market being wrong. He argues with the price, holds his position stubbornly, and grows angry as his losses mount. He is defending his ego, not his bankroll. The rule: the professional is a slave to the tape. The amateur is a master of his own opinion. You must learn to subordinate your own views to the market's verdict. The price of a stock is the final authority. Do not argue with it. Do not try to reason with it. Listen to what it is telling you, and act accordingly, without emotion and without delay. This is the path of the professional. It is a difficult path, paved with discipline and self-control, but it is the only path that leads to consistent success.